Well, hello, everyone. My name is Mark Paris. I'm the managing partner of McMullen McPhee and Company. I grew up on a cattle ranch down in Butte Valley, Nevada. I was allergic to hay, so I got out of that profession and chose this one. But I've been doing this for, I don't know, 38 years or something like that. I do serve a lot of ranching clients and hay farmers and cattle producers. And I do have one dairy client, and but we have offices in Elko and Ely, Nevada, and we have about 13 employees total, and we service a lot of variety of clients in addition to livestock industry. But the one thing I just kind of wanted to mention, I get a lot of questions about, we usually get those right before year end as to how much we can write off or what we can buy. And really anything you buy for the ranch is a deductible expense, but you can actually buy $1 million worth of equipment and write it all off in before the end of the year. The other important thing to note is you don't have to pay cash for that. So if you go out and finance a new swather or a new tractor or any type of equipment, you can still write that all off even though you haven't paid for it. There are some drawbacks to that in that in the future, when you're now making those payments, you don't get any deductions other than the interest that you pay on the loan. So if you take it all in that first year, then as you're paying back the loan, you're not getting as much deductions going forward. So that's something you'd want to work with your tax preparer on to kind of figure out how to do that. A lot of people try to, prepay their expenses. If they've had a good year, you can do a lot of that by, prepaying your fuel and your maybe fertilizer or whatever your supplies are that you're going to need for the upcoming year. It really has to be only 1 year's worth of supplies. So you can't buy 20 years worth of fuel. You can only do one year's worth. But the main thing I was going to talk about today is because I think this has affected a lot of ranchers in Nevada, is the tax relief for cattlemen that's been impacted by a natural disaster. And primarily that's drought. So we've been in a severe drought here for the last several years, and people have had to sell off a lot of their livestock, their cows, because there's no feed. So the IRS has two different provisions for that. And it also can be flooding. So I don't know. I know we've had some flooding down in Reno in years past, but I don't know that we've had any flooding. We might now that we're getting all these storms, so that might be for next year. But this is still something we can look at for the 2021 tax filing year. If you had to sell a lot more livestock than you normally would have, there is a deferral for that. So it is, and this is something I really encourage you to visit with your tax accountant to make sure you're taking advantage of these two different options. The first option is Internal Revenue Code Section 1033. I know a lot of people have heard of 1031 exchanges, where you can sell a piece of real estate, and then there's really strict rules to that, but then you can buy another piece of real estate and take advantage of that. On the 1031, and they've changed those rules a little bit, because it used to be you could do 1031 on personal property, but you can no longer do that. So now the 1031 is only on real estate. But I get a lot of questions. You can sell your ranch and you can buy a high-rise building in downtown Manhattan and do a 1031 exchange. And keep in mind that that's only a deferral of the gain, because when you do that, the gain on your sale of your ranch just gets deferred onto the property that you're purchasing. And it does not have to be another ranch. It can be commercial property, it can be bare land, it can be mini storage units, just has to be real property. But that's something that we get a lot of questions on. But this code section 1033 specifically deals with cattle producers that elect to postpone paying the taxes on the gain of their breeding, draft, or dairy animals. But the problem, and this has to be replaced within a certain time frame in order to defer that gain onto the new property, onto the new livestock. And the way this is calculated is it's livestock sold in excess of your usual business practices. So a lot of ranchers, whatever they cull their cows every year, they might be selling 50 or 75 head of old cows, and replacing them with replacement heifers. But what this is you have to go back and look at the average over the last 3 years of old cows that you've sold. So if you normally sell 75 cows a year, but this year you sold 175 because you don't have the feed for them, or so then that extra 100 head of cattle, you can defer that, but you have to buy them back within. And there's some special rules I won't get in. It's either within 2 years, but there's also, if the drought is still continuing, it can be as long as 4 years. But they do give you that 2-year window, and it's a tax year. So if you sold cattle in November of 2021, you have until December 31st of 2023 to replace those cattle. And so, like I said, it just defers that gain onto those cattle down the road. It doesn't get you out of the tax completely. The other method, or the other thing that's a big item, is Internal Revenue Code section 451G. And this allows cattle producers who use the cash method of accounting. So if you're not using the cash method of accounting, this does not work for you. But you can elect to defer for 1 tax year the income from certain livestock that were sold due to weather-related conditions. So kind of the same thing. If you had to sell your calves early, maybe you normally sell them as yearlings or whatever. But if you had to sell these animals because of drought, you can just elect to say, okay, I'm going to pick that income up next year, and it's just a 1-year deferral of the income, and you don't have to replace them. That's just a deferral. A little more specifics on the 1033 election. It's something that you just file an election on your tax return. Obviously, your accountant will do that, but you have to explain, attach an explanation to your tax return as to your name and address and ID number, kind of the number and kind of livestock that you sold. One thing that's interesting is you cannot sell commercial cattle and replace them with registered cattle. So you think a cow is a cow, but you can't sell just a non-registered cows and then go later and replace them with registered cattle. Those are not considered like kind. But then you have to provide an explanation to the IRS as to how many animals you normally sell, and versus the average over the last 3 years versus what you actually sold this year, and you calculate that gain and you report to the IRS, this is the amount of the gain that I'm deferring. One of the things, everyone, when you talk to someone, they all say that we're in a drought, which is pretty true, but it has to be a federally designated drought area by the FSA or the USDA, however they do that. So you can't just say, and they have specific maps that say where the drought area is and all of that. So you do have to be in that federally declared disaster area. There are some provisions also for cattle that are destroyed by disease. So if you had to sell the cattle because they were diseased, it kind of follows the same rules, but you have to replace those property with non-diseased cattle, I guess, down the road. So let's say, so then what happens is 2 years from now, when you buy these replacement cattle, you have to provide information to the IRS saying the date that the replacement animals were bought, the cost of the replacement animals, the number and kind of replacement animals, and you have to have a copy of the information you attached to the original tax return from the year in which you claimed that involuntary conversion. Now, some people say, well, what happens if 2 years from now I decide I don't want to replace these cattle? Well, then what you have to do is you have to go back and amend the 2021 tax return, or whatever year you made that election. You have to file an amended return and pick up that income. You can't just say, well, I'm going to pick up the income in 2 years from now. You have to go back and amend that return and pick up that income. So the difference there a little bit between these two methods is the 1033 election is not limited to cash basis taxpayers. So you can be an accrual basis taxpayer. Most ranchers that we know are not accrual based, but we do have a few. And so that the 1033 election is not limited to cash basis. However, the 451 election, where you're just deferring it 1 year, that you have to be in the cash. You have to be on the cash basis. And on the 451, the 1 year deferral of the income, it is important to note that livestock may be either raised or purchased animal, and they may be held either for resale, such as inventory, like calves or steers and heifers, or they can be for productive use. They can be depreciable livestock as well. So depreciable livestock includes dairy, breeding cattle, draft, or sporting purpose animals. You make the election, the 451 election is made basically the same as the 1033 election. You just have to file a separate statement election saying that you're electing this 451G election and telling how many animals you've sold and how many you normally sold and all of that. And then, as I mentioned, it's important that your area is declared a federal disaster declaration. Let's see. So yeah, and then it says, well, which one do I want to do? It really depends. So I mean, whichever one's going to give you the better advantage, and that's something that you're going to have to work with your accountant to kind of look at and to see which one of these deferrals are the best for your particular needs. Another couple of things that I want to touch upon is some of these CARES Act. I know there's a lot of different programs out there that people got money from the government. Some of those CARES Act money is taxable. The ones where they gave you just like so much per cow, you're going to get from the FSA or the USDA, you're going to get a 1099. I mean, it's similar to some of these drought relief monies that you get. I mean, those are generally taxable when you receive those funds from the government. The one which I don't know that a lot of ranchers were able to do this, but they did have what was called the payroll protection plan. A lot of businesses were able to apply for a loan through, it was done through a bank, but it ultimately was done through the SBA, and they got what they call a PPP loan. And there was lots of fighting actually between the IRS and Congress said that, well, they came out and said that these PPP loans were not taxable. So if you received a PPP loan that was forgiven, that was a tax-free transaction. But the IRS came back and said, well, okay, but if you spent money that from a tax-free income, then you can't deduct the expenses, which would be your payroll. And anyway, Congress actually took an act of Congress, but they changed the law and said, no, this is not taxable income. These PPP loans are not taxable income. You did have to prove that you were, well, you didn't have to prove, but you had to explain that why you thought you were eligible for the PPP loan and that you were affected and by decreased income because of COVID. And that's where I think just the cattle producers probably didn't experience a lot of that. And you do have to have payroll. You have to have employees on the payroll to get the PPP loan. So if you're kind of a small rancher and family operation and you don't really have any employees, then you would not be eligible for the PPP loan. And there was 2 phases of that. They had a first phase. Some of that happened in 2020, but there was a phase 2 where you could apply for that PPP loan again in 2021. The one thing that's important there is that if you did apply for that loan, you now have to apply for forgiveness. So you still got to make sure you do that final step. And the banks are kind of, they'll keep you honest because they don't get paid from the SBA until you get approved for forgiveness. So it funnels through local banks, but it ultimately is coming from the SBA. But the bank's the one that gives you the money. And if you don't apply for the forgiveness, then you do have to pay it back. But so the banks will keep you informed of that and make sure that you apply for the forgiveness. We've had a few that just thought it was free money and didn't think about applying for the forgiveness, and the bank calls them up and says, hey, we need your forgiveness application. And then I think the other thing I want to talk about is a little similar to the PPP loan. It's called the ERTC credit, and it has to do with payroll again. But most ranchers only file a 943 payroll form for the whole year. So some of this was available like per quarter. I mean, I had a client that got $178,000 earned income or our ERTC credit for the first quarter of the year. And that you have to show, or that you have to be able to prove that you had like I can't remember now if it was a 20% or 25% reduction in your revenues for that quarter. And that's where like ranchers, they get 1 check a year usually. I mean, milk producers and maybe in the Fallon area might be able to show that. But basically they were paying either $5,000 or $7,000 per quarter per employee. And that is going to be taxable, but it's still kind of free money. So that's something that you apply for on your 943 or your quarterly 941 payments, but you might want to visit with your payroll people or your accountants to see if you're eligible for that. Like I said, a lot of ranchers are not, but it doesn't discriminate against ranchers. I mean, they are eligible if they qualify. So I think that's all I have for now. I could talk forever, but I'm sure you've had enough of me. So I'll let you go. I do appreciate your inviting me, and I hope some of these storms that we're getting will relieve some of this drought conditions that we've experienced. I know it's been very difficult on the cattlemen, especially around Elko County where I'm from. But so thank you very much.